welcome to another session of Stop, Look, Listen, and Learn. Today we're going to be talking about par rates, spot rates, and yield to maturity. We're going to be looking at the relationships between these three rates. First, we want to start off by explaining exactly what par rates are and what spot rates are. And then we'll move on to describing the bootstrapping process that is typically used to compute the spot rates. And then finally, we will examine the relationship between spot rates and yield to maturity. So let's get started. What are par rates? Basically, all bonds have a stated rate or a coupon rate that's stated in the contract or the bond indenture, and that rate stays constant throughout the life of the bonds. The stated rate or the coupon rate is also referred to as the par rate if the bond is trading at par or its face value. And typically when bonds are first issued, the coupon rate or the stated rate is set at a rate that enables the issuer of the bonds to sell the bonds at par. So that's basically what the par rates are. Pretty simple and straightforward. So now let's look at spot rates. Now there are fundamentally two types of bonds. There are coupon paying bonds and then there are zero coupon bonds. Zero coupon bonds do not pay any coupons and they are sold at a discount to their face value. And what the investor receives is the face value of the bond at maturity. So if you buy a 10-year zero coupon bond, you'll pay a discounted price, and at the end of 10 years, you would get the face value of the bond, and during that 10-year period, you will not receive any coupon payments. And the yield on a zero coupon bond is referred to as the spot rate. Sometimes you'll also see it referred to as the zero rate, and that's because it is relating to a zero coupon bond. So if you were to buy a 10-year zero coupon bond and the yield on that zero coupon bond was 6%, then what we would say is that the 10-year spot rate is 6%. And then spot rates are used to value coupon paying bonds, and we'll see an example later on. Now let's look at the bootstrapping process. Essentially, the bootstrapping process is the method that is used to compute the spot rates, and that method involves starting with the par rates and then using those par rates to compute what the spot rates will be. And let's take an example to show how this is actually done. So let's say we start off here with the par rates, and we have the 1 year, 2 year, 3 year, and 4 year par rates. And as I said earlier, the par rate is usually set so that when the bond is originally issued, it is issued at its face value. And so those would be the par rates. And so here we see that the 1 year par rate is 2.5%. The 2 year par rate is 3.5%. The 3 year par rate is 4.25%, and the 4 year par rate is 5%. And from that par rate curve, we want to compute what the spot rates would be. So let's take a look at how we do that. Now, the first thing you always want to remember is that the 1 year spot rate is always equal to the 1 year par rate. So in our case, the 1 year par rate is 2.5%. So that means that the 1 year spot rate will also be 2.5%. And then we move on and look at the 2 year par rate. And once we have that, we compute the 2 year spot rate. So if we go back to the slide here, we see that the par rate for the 2 year bond is 3.5%. So that means that this particular bond, let's assume $100 of face value, then this particular bond would pay an annual coupon of $3.50. And so what we want to do is figure out what the 2-year spot rate must be in order for this 2-year bond to trade at par, which would be $100. So we already know that the 1-year spot rate is 2.5%. So we'll take the coupon that we'll be receiving 1 year from now, which would be $3.50, and we'll discount that at the rate of 2.5%. And then we'll take the cash flows we're going to get 2 years from now, which will be equal to the coupon rate of $3.50 and the face value of the bond, which will be $100. So at the end of 2 years, we will receive $103.50, and we'll discount that cash flow at the 2-year spot rate, which is what we're trying to determine here. And so the 2-year spot rate is equal to 3.5177%. And essentially what you do in order to calculate that rate is you take the amount you get when you divide $3.50 by the 1-year spot rate, which is 1.0250. And then you take that amount and then you subtract that amount from 100. And then what you do after that is you do some algebraic manipulation to solve for the 2nd-year spot rate. And essentially what you would end up doing is taking the square root of 1 plus the 2nd spot rate squared. And let me just give you an example of how you would do that. So essentially what you would do is you would have 10350 divided by 1 plus 2nd-year spot rate squared, and that is going to be equal to 100 minus whatever you get when you divide $3.50 by the 1-year spot rate, and that number comes out to be, so it'll be 103.5 squared, and the number on the right hand side comes out to be 96.5854. And then what you do, then you move the denominator over and then you divide by 96.5854. So what you end up getting is 103.50 divided by 96.54, and then you determine what that number there is, which I believe it turned out to be 1.0716. And then of course you have to take the square root of both sides, and then that will give you the 2nd-year spot rate, which would be equal to this number here minus 1. And if you go through the math, you'll see that that turns out to be 3.5177% there. And so now we have the 1-year spot rate and we have the 2-year spot rate. And with those two spot rates, if we go back and we look at the 3-year or the 3-year bond and see what the par rate is on the 3-year bond, and we see that that is 4.25%, And so what we do now is we take that 3-year bond and we determine what the cash flows will be, because the par rate is 4.25%. That means that this 3-year bond, after 1 year, will pay a coupon of 4.25%. I mean $4.25. At the end of year 2, it would pay another coupon of $4.25, and then when it matures at the end of 3 years, it will pay a coupon of $4.25, plus it will repay the principal. So you get a total cash flow of $104.25. So what we want to do is discount those 3 cash flows back using the spot rates. So we know what the 1-year spot rate is, which is this number here, and so we're going to discount the cash flow that we're going to receive 1 year from now at that 1-year spot rate. And then we also now know what the 2-year spot rate is, which is this number here, and we're going to discount the cash flow that we're going to receive 2 years from now at that spot rate raised to the 2nd power, because it's 2 years into the future. And what we're trying to determine now is what is the 3-year spot rate. What must the 3-year spot rate be in order for this bond to trade at par? And so we'll go through the same process. So both this term here would be a number or constant. This term here would be a number or constant, and we take both of these numbers, subtract the sum of these two numbers from 100, and then we go through the same process we went through before to solve for S3. And in this case, we'll be taking the cube root in order to get rid of the 3rd exponent here. And when you go through all of the algebra here, you see that the 3-year spot rate turns out to be 4.3%. Now that we have the 1-year spot rate, the 2-year spot rate, and the 3-year spot rate, we can now utilize the 4-year coupon bond and determine what the 4-year spot rate would be. So we see here that the par rate for the 4-year bond is 5%. So what we would do here is we would again determine what the cash flows will be for this particular bond. And since we have a face value of $100 and the coupon rate or the par rate is 5%, that means that this bond will pay $5 for each of the next 4 years. And then at the end of 4 years, when the bond retires, it'll pay a $5 coupon, plus it will repay the principal. So what we want to do is to discount those cash flows back at the appropriate spot rates. So again, the $5 coupon we're going to receive 1 year from now, we will discount that back at the 1-year spot rate, which is 2.5%. The $5 coupon that we're going to receive 2 years from now, we'll discount that back at the 2-year spot rate, which is 3.5177%. And then don't forget to square that, because we're 2 years out into the future. And then the 3rd cash flow we're going to get will be $5 at the end of 3 years, and then we're going to discount that back at the 3-year spot rate, which we just determined was 4.3%. And again, don't forget to raise that to the 3rd power, because that cash flow comes 3 years into the future. And then finally, at the end of year 4, we're going to get a cash flow of $105, which would be the sum of the $5 coupon and the $100 face value. And what we want to do now is determine what the 4-year spot rate must be in order for this 4-year bond to sell at par, or $100. And if you go through the arithmetic, you will determine that the 4-year spot rate is 5.1%. And so this is an illustration of the bootstrapping process. So we start with the 1-year spot rate using the 1-year bond, and once we know the 1-year spot rate, Then we look at a 2-year coupon paying bond, and we get the par rate for that 2-year bond. And then utilizing the 1-year spot rate, we bootstrap or determine what the 2-year spot rate will be. And once we know the 1-year and the 2-year spot rates, then we go to the 3-year coupon bond, and utilizing that 3-year bond and the 1-year and the 2-year spot rates, we can then determine the 3-year spot rate. And then in a similar fashion, once we know the 1-year spot rate, the 2-year spot rate, and the 3-year spot rate, then we go to the 4-year coupon paying bond, and utilizing the 3 spot rates that we know, we can determine what the 4-year spot rate will be. And that's what the bootstrapping process is all about, right? So now that we have the spot rates, then we can use the spot rates to basically value a bond, right? And that's what we're going to look at now. And the reason we do that is because we want to determine what the yield to maturity of the bond will be. Now, here we have 4 spot rates, but oftentimes you want to distill that down to basically 1 rate. Now, what is the yield to maturity? The yield to maturity is essentially the return that an investor will realize if they hold a bond to maturity. 2, all of the coupons and the principal or the face value are received on time. And 3, the investor invests all of the coupons at the original yield to maturity when they purchase the bond. Now, that's not a very realistic assumption because interest rates are constantly changing. So the interest rate on the date that you receive the 1-year or the first coupon is probably going to be different than what the interest rate is going to be when you receive the 2nd-year coupon. And so you very likely are not going to be able to invest all of those coupons at the same interest rates. And so as a result, it's not likely that you're going to realize the yield to maturity on the bond. And sometimes the yield to maturity is also referred to as the internal rate of return on the bond. And so I just wanted to point that out just in case you see that, you'll know what they're talking about. But essentially, if you distill everything down to its essence, the yield to maturity is simply a weighted average of the various spot rates. And so you take those 4 spot rates and you take a weighted average of those 4 spot rates and you get 1 rate. And sometimes that makes it easier for you to, look at, things and compare bonds very quickly just by looking at their yields to maturity versus looking at the spot, the term structure of the spot rates, if you will, right? So the steps to computing the yield to maturity on the bond. So basically, the first thing you need to do is to value the bond using the spot rates. And then after you compute that value using the spot rates, then you're going to use a financial calculator or a spreadsheet program to compute the yield or the yield to maturity on that bond based on the value that you derive by using the spot rates. And this is probably best illustrated by walking through a simple example. So let's say we have a 4-year, 6% annual coupon bond, and we want to determine what the yield to maturity is on that bond based on the spot rates that we just computed. So the first step is going to be to value that bond. Now, the face value of the bond we're going to assume is $100, and it's a 6% annual coupon bond, which means that it's going to pay interest of $6 for each of the next 4 years, and then at the end of 4 years when the bond matures, it's also going to repay the principal. So 1 year from now, we're going to receive $6, and so we need to discount that back at the 1-year spot rate, which we determine is 2.5%. Then 2 years from now, we're going to receive a coupon of $6, and we need to discount that back at the 2-year spot rate squared, and then at the end of 3 years, we're going to receive another $6 payment or coupon, and we need to discount that back at the 3-year spot rate cubed. And then at the end of 4 years, when the bond matures, we're going to receive a $6 coupon and the return of the principal for a total of $106. And so we need to discount that particular cash flow back at the 4-year spot rate, which we previously determined to be 5.1%, and we need to raise that to the 4th power to reflect the fact that that cash flow is coming 4 years into the future. And then we sum all those items and we arrive at a value for this particular bond of $103.62 if you round. So that's the first step. Now that we have valued this bond based on the spot rates that we have determined, then we want to utilize our financial calculator or a spreadsheet program like Excel or Python or something like that to determine what the yield to maturity of the bond will be. And so just using a financial calculator, using your TVM roll, so you would clear it out to make certain any previous calculations you made have been cleared out. And then you want to enter the present value of the bond, and you want the present value to be what we just computed, which is $103.62. And you want to enter that as a negative, reflecting the fact that if you invest in this bond, you're gonna have to make an outlay of $103.62. And then we know that the future value of the bond is going to be $100, because that's the face value of the bond, and that's what we're gonna get when the bond matures. And we know that this is a 4-year bond, so or the number of periods will be 4 years. And then we also know that this bond is going to make an annual payment, an annual coupon payment of $6 each of those 4 years, so the payment would be $6. And when you enter those 4 items, then you hit compute IY or compute I if you're using the HP 12 calculator, and that will give you an interest rate of 4.9807%. And that represents the yield to maturity on this particular bond here. And that 4.9807% is really just a weighted average of all of the spot rates that we just computed. And one of the things that you'll note is that that yield to maturity is very close to the 4-year spot rate. And if we go back, we see that the 4-year spot rate is 5.1%, right? And the yield to maturity that we just calculated is 4.98%. So it's very close to the 4-year spot rate. And the reason it is greater than the spot rates for the first 3 years is because, as I said earlier, this is a weighted average of the spot rates, and the weights will basically be the present value of the cash flows. And so the most weight is going to be at year 4, and that's because we're going to get not only the $6 coupon payment, but we're also going to get the $100 as well. So we get a total of $106. And so that's why the yield to maturity is always going to be very close to the last spot rate that you compute. And just to do a sanity check here, so this bond has a stated rate of 6%. So when it was issued, it was paying 6%, and now it is trading in the market at 103, or the value of it is $103.62. So it is trading at a premium, and what that means is that the rate on the bond must have declined, because recall that there's an inverse relationship between the value of a bond and the interest rates. So if the par rate was 6% when this bond was issued, it would have been trading at $100, and then if the rates declined, the market rates declined, then the value of this bond will have increased. And so we see that the rates have declined down below 6%, so that 4.9807% makes sense, given that this is a bond that's trading at a premium to face value. And so that's pretty much all I wanted to cover here, is just to describe what par rates are, what spot rates are, and what the yield to maturity is, and how all of those things are interrelated. And in future videos, I will talk about forward rates and how you go about computing the forward rates. And so I hope you found that helpful. If you have any questions, please feel free to drop a comment and I will respond to you. In the meantime, best of luck as you prepare for your exams, and don't forget to subscribe to our channel. Thanks, and have a great day.